Hello and welcome. The European currencies spent the first half of the previous trading week standing still in anticipation of the ECB's decision on interest rates. However, the key focus was the regulator's press conference as market participants wanted to find out whether the ECB would tighten monetary policy or keep its loose and growth-supporting stance. As expected, European Central Bank President Christine Lagarde said the regulator was preparing to be more aggressive in its further steps. She noted that the bank would phase out its bond buying program sooner than planned. Investors took the more rapid withdrawal of asset purchases as a sign that interest rate hikes are nearing. Now markets are betting on a rate increase in October rather than in December as predicted earlier. They expect the key rate to return to 0.25% in 2023. This news provided the European currency with a bullish signal. The quotes were in an uptrend until statistics on the US economy were released. US inflation surged again nearing 8%. Notably, February data does not include recent spikes in energy costs following the start of the Russia-Ukraine military conflict. Therefore, inflation rates in both the United States and the euro area are expected to rise further as commodities are becoming more expensive, thus affecting the core consumer price index. It can be seen from the trading chart that the greenback reacted positively to US inflation data. The American currency gained value against the euro and the British pound. A more aggressive approach taken by the Fed and a strong run of interest rate hikes support the US dollar. Markets are aware that the central bank is prepared to act more decisively at future meetings, which paves the way for a possible 0.5% rate hike as early as March. Today's macroeconomic calendar includes statistics on UK GDP for January. Britain's economy is forecast to have rebounded by 0.2% in month-on-month terms in January after a 0.2% decline in December. The annual average growth rate is projected to 0.8%. Besides, the UK is set to release data on inflation production, which is also expected to be rather upbeat. In general, these reports may support the pound sterling. However, geopolitical tensions, expectations of interest rate increases by the central bank, as well as inflationary pressures continue to weigh on an already fragile economic environment of the country. Today, traders may also take notice of Germany's consumer price inflation for February and the Michigan Consumer Sentiment Index from the United States. From a technical point of view, it's worth focusing on the resistance level 1.1017. Long position will be relevant if the price slides and forms a false breakout at 1.0947. Alternatively, traders may go long at 1.0879 and rebound with a view to catching an entry correction of 30-35 pips. In the event of false breakout at 1.1017 and downbeat data from the euro area, I recommend opening short positions, counting on the breakout of 1.0947, followed by an approach to 1.0879 and 1.0810. An inflation surge in Germany could boost demand for the euro if the price consolidates about 1.1017 and tested from the top down. A buy signal will be created. Thus, the euro-dollar pair will most likely return to 1.1066 and probably hit 1.1115. At this level, it will be possible to go short on a rebound, hoping for an intraday correction of 25-30 pips. Short positions at 1.1066 can be considered only in case of a false breakout. In this case, the pair is expected to close below 1.1017, thus forming the upper boundary of a new descending price channel. Speaking of the British pound, the currency continues to lose value. The pound sterling is expected to slide to 1.3034 and 1.1276. As you know, the economic situation in Britain is challenging. Surging inflation is hampering its economic growth. Even interest rate hikes will hardly make things better. The situation requires a more aggressive monetary policy stance on the part of the Bank of England. Only then market sentiment may change to bullish. In the event of a correction, a false breakout in 1.3111 will make it possible to open short positions. In this case, the pound sterling is likely to go down to the level of 1.3034. Its breakout will lead to a further decline, and the pound-dollar pair will fall to 1.2976 and 1.2914. If the UK GDP data turns out to be worse than forecast, the British currency will face steep losses. In case of upbeat statistics on Britain's economy, bulls will have a chance of regaining control over 1.3111. If the price consolidates about this mark, the volume of long positions will increase and the pound sterling will return to 1.3190. At this level, I recommend going short on a rebound with a view to catching an intraday correction of 35-40 pips. Good luck!